Do you want to talk about Dutch ovens, Steve?
Dutch ovens?
Yeah.
Is that what we're calling it now, is it?
That's what I'm calling them. I know, I've got it written down that they're not called Dutch ovens, but that's what I want to call them this time.
Do you know what Dutch ovens do, Steve?
Yes, I do. They have two meanings. One of the meanings, we own them. But tell me about your experience with Dutch ovens recently.
Right, okay, so Dutch Brothers, or Dutch Bros. I'm not actually sure you meant to pronounce it. It must be Brothers. I can't, but they do shorten it down. So they're it's not one we've spoken about much. They're another one in my capital incinerator pie, as was Etsy and Teladoc. But they're a coffee and cold drink outlet rivaling Starbucks, but they're a lot smaller. They're about 5.7 billion in market cap. And I think Starbucks is probably still over 100 billion, although that could change between now and the close of the market. But Dutch Brothers are growing pretty quickly, and actually they actually come out top on surveys amongst millennials and younger on preference between the two. So it's quite an interesting looking company. But I'll give you the financials. Revenue rose 44% in Q4 to 201.8 million, beating expectations pretty handily. They reported a positive adjusted EPS of 3 cents, which was falling short of the 7 cents that was expected. They guided for sales to reach 950 million to 1 billion, and this is genuine growth because they've got no plans to raise prices. This will represent about another 35% growth. Adjusted EBITDA grew 115.7% to 29.8 million. So some of this is going to trickle down to the bottom line. It slipped a little bit year on year because there's just been an increase in input costs. So they're going to do this by continuing their rapid pace of store openings. They're going to open 150 by the end of the financial year, of which 130 of them, Steve, they want to operate themselves. They're still on track to have 1,000 stores by 2025. Coincidentally, franchise restaurants companies actually tend to perform better than company-operated ones, so it'll be interesting to see how this plays out. But their model at the moment currently has 26% gross margins on company-owned branches, and that's pretty good for a coffee house. They're also projecting low single-digit same-store sales growth next year as well, so there's going to be a little bit of growth push there. So for valuation-wise, this one's trading at a couple of times sales. It actually has 100 million of long-term debt on the balance sheet, which is neither here nor there. But the problem is it's a little short on cash. When I was looking down at it, they only have about 20 million, somewhere around that kind of amount. So I think we're going to see a secondary offering soon. I think, or some kind of bond offering perhaps, because the rate they're expanding, it isn't going to be cheap. And I don't think they've quite got the earnings at the moment to support it. But I don't think they're a million miles away, Steve, and I think that makes it a pretty interesting one to look at.
Do you think it's likely to be debt, or do you think it's likely to be equity?
I think it'll be equity, because I think after an IPO, you usually, well, I mean, speaking from history, you almost always got a secondary offering if a company came quite early. So I would be very surprised if it was a debt raise and not an equity offering. They're still trading at a fairly decent price. They're way down from their IPO, but they're still trading at a fairly decent price. 2 times sales, you would say, is probably about the right kind of, time to start offering a bit of stock.
I guess the kind of conventional wisdom then for a company that's in sort of rapid expansion mode and is ticking along with some cash but probably not enough cash is that you do this via equity rather than debt, basically. Debt, you have to pay it back. Leave aside the thought about interest rates for the moment. If your cash isn't where it needs to be just yet, you hadn't better go taking on something else that will cause a bondholder to come banging on your one of your, what did you say, 150 new doors or something like that. I was interested in the fact that they're sort of mostly not franchised, though. That's a kind of unusual way of going about things.
It is a very unusual way of doing it, but like I say, they're modelling on their current stores that they've got open this decent margin. So they must just be thinking, if we can take that forward, this will be a decent business. I was looking down the list of sort of the franchise the company operated, and it's strange really, because at IPO, when I first took a look at this company, it was pretty much near as damn it more franchise than company operated, but only by a little bit. And then it's just been rocketing away in company operated, and you've got to wonder, and there's not a lot of commentary on why they've chosen to solely focus on that. You would think that if you were going to expand stores, one of the sensible things to do would be to say, okay, let somebody else build it, build the building, we'll supply the marketing literature and the materials, and you go and franchise run it. Plus, we'll use some of the cash we've generated to also build some, because, you're basically growing twice as fast that way. But they're choosing not to do that, and I guess they just want more control over the product, the quality, and the customer service.
We said it's a kind of uncommon way to do things, and it's certainly an unintuitive way to do things. I think it's also the way Starbucks does things. They are mostly owned as well, rather than franchised. I think they're almost entirely owned, from what I can remember of them. There's definitely a kind of move amongst these kind of places to do that, and I guess one of the nice things about setting up a Dutch Brothers outlet as opposed to, say, a Burger King outlet, which is more usually franchised, is that I suppose I don't know them at all as a place to be, but I guess the startup costs are lower because you don't need a full kitchen, basically.
Yeah, it is literally sometimes just a hut with a couple of coffee machines and a milkshake machine. If you look at some of their presentations online, you look at the things and you think, you're not going to get many people in there, and you realise it is almost just like a pickup lane. But and it's anecdotal, obviously, but if you ever look at Dutch Bros on Twitter, you'll see people complaining that the queues and the car queues are so long that they don't want to queue in that lane. And that's a nice problem to have for somebody like Dutch Bros, especially in this kind of environment. So, I mean, we'll see how this continues. This could be one of those fads, the next Dutch Brothers comes along, Starbucks wins, and it's whoever comes in second. But I think Dutch Brothers is a really interesting outfit.
Yeah, it's fascinating that. I mean, it could be the case that they expand too fast, and especially in a fairly... aside from what I said about the setup costs being lower because you don't need a full kitchen or indeed that much stuff in it, and presumably operating costs are lower, it is still more expensive than franchising, and then that kind of brings with it a bit more risk. But nonetheless, I mean, it's a kind of attractive sort of business. Coffee in general, it seems to be sort of fairly robust, no pun intended, as a kind of thing that's likely to carry on. Chris Hill was on our show and he said, look, I don't know what a lot of things in the future are going to look like, but I do know that people will be drinking coffee in 10 years' time, and I've got a good idea of how they'll be getting it as well.
Yeah, true. And obviously there's also the Olive Garden approach to come here, where they could just sell off some of the buildings they own and to somebody like Four Corners, who I'm sure would be happy to hoover them all up and give them a decent rate for them, and they can continue building that way. It's there's plenty of ways to build out in this business. It'd be interesting to see how they get on. It's a very small position in the money incinerator pie, which is a very small pie anyway. But it's one that I perpetually look at and think it won't be one of the ones I cut anytime soon.
How's the stock been doing lately?
Quite poorly, but it's just in the
IPO,
sort of,
right?
Yeah, because it's in the IPO. It actually IPO'd at a pretty high price as well, which was to generate the sort of cash it needed to do the sort of growth it's done. So, I think they'll be shrugging their shoulders at that at the moment, saying like, well, we're a coffee outfit, we're not giving out much equity to anybody other than management, and if management are getting equity, they should see the bigger picture. Yeah, I don't have much else on that. Steve, do you have much else?
No, I'm all right with that idea. It does make me think that I will sit and watch this for a little bit then to see whether another kind of placement comes around, and if it does, perhaps take another look then. I mean, it feels like if we think there's likely to be needing cash to fund this, and that's likely to come via dilution rather than via debt, either way round is tricky, I guess. But I'd rather wait for that to happen and then see where we end up than try it beforehand.
Yeah, that's my point as well. I think if I was a buyer today, I would just be waiting to see how this plays out. I think the only time it could go wrong for you is if they started selling assets to fund expansion, because I don't think the market will care about that too much. But I think if there's a decent-sized dilution or a decent-sized debt offering come on, or a bond offering come on, I think we will see a drop in the share price, at which that might be time for an opportunistic investment.